Hi, this is Helal. In this video on Graphing in Economics series, we will solve a situational question. The question is, draw a perfectly competitive market at equilibrium, show the impact of price ceiling, mark the new price and quantity exchanged, share the producer surplus, consumer surplus and deadweight loss resulting from price ceiling. So we have to graph out this situation. So first of all, we start by drawing the usual demand and supply curves. Let us say this is our quantity axis, this is our price axis. We draw the usual demand curve and usual supply curve. Okay, this is our demand and supply curve, and we mark the equilibrium price and quantity. Let us say this is the equilibrium price and this is our equilibrium quantity. So this is the first step in solving this question. After that, we have to show the effect of the impact of the price ceiling. Now we draw the price ceiling and mark the price. So we draw the price ceiling. Let us say this is the price ceiling which is below the below the equilibrium price. That is to say, since this price, it is binding or it is effective, it goes below the equilibrium. Equilibrium was this point and it goes below the equilibrium. That is, here the quantity demanded at this artificially low price will be higher than the quantity supplied. That is, on this line we can see that the quantity demanded is this very much, but this quantity supplied is only this point. So there is a shortage between quantity demanded and quantity supplied. We can see here the quantity demanded is this very part, but supplied is only this very and this very point, or up to this point is only supplied, and up to this is quantity demanded. So there is the difference. The quantity demanded is more than the quantity supplied. In case of price ceiling, this creates the shortage, but the quantity sold will be lower. Now the quantity sold will be lower. That is, quantity is only sold up to this point, where this is the effective price, or which is the binding to all the people here. So what will we do? We will draw this very line, that is QS, or I will say this is the quantity which is sold by the effective price ceiling. Okay, since this QC is all that is sold, the triangle, so I will go up to this point. Now this triangle in the center is the loss of economic surplus, so it is deadweight lost. So our deadweight lost will be this very area. So this green triangle is the deadweight loss arising by the price ceiling here. Okay, this is the loss of the economic surplus, which we call the deadweight loss. So this is our deadweight loss. Now the low price makes the producer surplus the small triangle. That is, the producer surplus will be less here. So this very part is the producer surplus. This triangle, this makes it very small. Before equilibrium, it was, before this price ceiling, it was this very triangle, but after the price ceiling, the producer surplus has become small. Okay, at the bottom of the price down to the supply curve, that is, and the price down to the supply curve shows us the producer surplus. Now our the price up to the demand curve at QC is our consumer surplus. The price up to demand curve, that is the price up to demand curve at this QC is our consumer surplus. So our consumer surplus is our, this very portion is our consumer surplus. So this is the consumer surplus here, consumer surplus. Our dead weight lost is this very much of the triangle, and the producer surplus has become small because of the effective price ceiling. So this is how we graph this situation.